Listen, if you want to know how to look at any chart that you're looking at, give me one that you're super interested in.
Pan W.
I heard you talking about that. I own way too much of this thing. I just got.
I see. I don't own enough of it yet, and I'm like trying to make sure that I hit the right spot.
So let's take a look at it. Do you want to look at 30-day implied vol, or do you want to look at? Okay, so 42 days out is the 16th of May. Let's do that. That looks like about $23, way underpriced. My thought is that $53 is way underpriced. And so let's go and look at it. So we got 53, so that gives us about 210 or something on the top side, but only, I mean, literally, if we look at the long side of it, it's got a $53 spread. That's all the way down at 100, right? Mm-hmm. And so it's got a lot priced in there, but I think the better bet is on the failure to move to the upside unless you look at a leap. And of course, you know, I like those leaps that have spreads on them because they just matter. So here's the thing. The implied measured move puts us right around 100. Remember, it's going to be a little squishy. So you could say to yourself, okay, either I wait to 100 or I start watching for a price break here. And to me, listen, in times like these, folks, and I have been around the block a time or two. I don't think ladies are supposed to say that. All kinds of implications there.
Yeah, but I thankfully we have a mature group that knows exactly what you mean. But I understand the tiptoeing.
Yes. So, you know, not my first rodeo. And here's what I'm going to tell you. When the market begins volatility expansion and reflexive motion, remember, we are being driven by the option chains now. Once those expansions start beginning and credit spreads begin to widen, everything starts to snowball. First, hedge funds start de-risking and de-levering. All we have to sit down and say is, listen, there's a space for me to have an edge, and that's where everybody else began to buy. And for Palo Alto, I don't see that number until 130. So it's at that, why? Why would I pick that one? You see this big pocket of motion? I think that's inventory accumulation in a very wide spread. If I take a look at maybe a quarterly bar, you're going to see all of those candlesticks just jammed right up together. See it? Just jammed right up together. So it's telling us, listen, a lot of people accumulated between this 140 and 180, and then just before the breakout, everybody said, hey, listen, 127 is the most I'm going to pay. And I suspect that that's where we're going to come. And a lot of people are thinking, oh my gosh, that's really far. Listen, we've been running for years, and we just have to go see all of the folks that have been used to making money really easy in the market. This is their first real introduction to volatility, their first introduction. And so what happens is everybody scoops everybody out and goes, listen, I'm going to sell and ask questions later. Notice this morning, we still have a little bit of green. That means they're still moving out of these guys into these guys. To me, that says we're not done yet.
Yep.
It's got to turn red, and it's got to stay red for a couple of days.
And I love that. I absolutely love that. One of the things that I was saying yesterday, Anne-Marie, as I was watching the carnage unfold, is I was like, this selling felt orderly all day long. all day long.
Absolutely.
It felt orderly. And I said to the first thing, because I've been around the block a few times myself, and not as many, but a few times myself. I said to myself, with this being orderly, that tells me that there's more downside. Well, look at what
Yep.
the market is doing here
Yep.
today. And so this is I think that's a really great mention, really fascinating. Consumer discretionary, those pockets seem to be in consumer discretionary. I would have guessed staples.
Yeah. And again, that's why here's something that's really interesting to me. We talked about it a little bit on the show. I was in the chat box and I said, what do you make of Bitcoin being up today?
Mm-hmm.
To me, this is something that says, look out, shorts. If you are planning on loading the boat short, I am going to step on your neck. And because what does this measure? Liquidity. It's measuring
Mm-hmm.
liquidity and it's completely decoupled from the NASDAQ. It used to run in tandem with it. Now it's
Mm-hmm.
completely decoupled. Now we're saying, wait, we're in the range. We're well above the low of yesterday. We printed above the high of yesterday.
Mm-hmm.
What goes? And so this is why I say, listen, if you're thinking about shorts, you better wait for a bounce. And if you're thinking about longs, you just have to let things just agitate themselves down in a region where they hold this sideways motion, right? And somebody just said Bitcoin up, gold down. I don't know why Lowell had to go there, but what I would say is this: we are in a financialized market, and that means when everybody starts sweeping out the cobwebs, everything goes because somebody's going to get a margin call and they're going to go, hey, you know what? That's been going great. I need to sell some of that gold to make margin in my other
Mm-hmm.
positions. It is very controlled.